What if I told you that one of the smartest financial decisions of the last 2 decades was also one of the hardest to make? It meant ignoring one of the most hypnotic, culture-shaping product launches in history. Back on June 29, 2007, Apple released the very first iPhone. People lined up for days, buzzing with an energy that felt like a revolution. For $599, you could own the 8GB model, a device that promised to put the internet in your pocket. It was pure magic. But what if you'd resisted? What if, in a moment of brilliant foresight, you had skipped the phone and taken that same $599 and bought shares in Apple instead? If you had, that $599 investment would be worth around $27,000 today. No, that's not a typo. $27,000. Instead of an obsolete brick of glass and aluminum that's probably in a landfill, you could have had a down payment on a car, a luxury vacation, or a serious head start on your retirement. This isn't just about a phone. It's about a choice we all face every day. The choice between being a consumer and becoming an owner. 1. A tale of two apples. Depreciation versus appreciation. Let's break this down, because the difference here is staggering, and it reveals a powerful secret about building wealth. When you bought that iPhone in 2007, you were buying a product. And like almost every piece of tech, it started losing value the second you opened the box. Think about the life of that physical iPhone. The first few months were amazing. You were one of the first people on Earth to have this futuristic gadget. You could pinch to zoom, browse the real web on a phone, and watch jaws drop. But then, just a year later, the iPhone 3G came out. It was faster, had 3G, and a new subsidized price of just $109 with a contract. Suddenly, your original iPhone felt a little less special, a bit slow. A few years after that, it couldn't even run the latest software. The battery faded. The cables changed. By 2012, it was a relic. Today, unless it's one of those ridiculously rare factory-sealed collector's items, your used 2007 iPhone is worth next to nothing. It's proof of the brutal, relentless cycle of consumer tech. Depreciation. It's a cycle designed to make you want the next new thing, because the last thing is already fading away. Now, let's look at the other Apple, the shares you could have bought. On that same day in June 2007, Apple's stock, adjusted for its many splits, was trading for about $3.66 per share. Your $599 would have gotten you just over 163 shares of Apple Inc. Unlike the phone, which immediately started to lose value, those shares represented a piece of a growing, innovating, and wildly profitable company. While your phone's screen was getting scratched, your shares were quietly compounding. While the phone's battery was dying, your investment was benefiting from every new iPhone being sold. Every single person who stood in line for the iPhone 3G, the iPhone 4, the iPhone 5, they were all contributing to the success of the company you partly owned. You weren't just a customer anymore, you were a partner. You owned a tiny slice of the App Store, a fraction of the MacBook assembly line, a piece of the profit from every iPad. The value of your investment didn't depreciate, it appreciated. And it did so in spectacular fashion. That's the entire game right there. The phone takes money out of your pocket, while the stock puts money in. 2. The numbers. A decade and a half of what-ifs. That $27,000 number is shocking enough, but what if you fell into the upgrade trap? What if, like millions of us, you bought a new iPhone every few years? Let's run those numbers, and the result is almost painful to look at. 2007, the original sin. This is where it starts. You skip the first $599 iPhone and buy 163 shares of Apple stock. This one move becomes the cornerstone of a small fortune. 2008, the iPhone 3G. The App Store has just launched, turning the iPhone from a cool gadget into an essential platform. Apple drops the iPhone 3G at a subsidized price of $190 with a 2-year contract. So tempting. But you resist and invest that $199 instead. The market was rough in 2008, but you're not day trading, you're in it for the long haul. 2010. The iPhone 4. A beautiful redesign. The Retina display. FaceTime. Steve Jobs calls it the biggest leap since the original iPhone. The unlocked model costs $599. Everyone wants one. It's a cultural moment. But you're thinking differently now. You see those lines outside the Apple Store not as a place to wait, but as a revenue stream for the company you own. You invest another $599. 2012. The iPhone 5. Taller, thinner, lighter. A new lightning connector that makes all your old cables obsolete. A classic move to keep the consumer cycle churning. The base model launches at $649. You stick to the plan and invest that money. By now, you're noticing that your first investment from 2007 is already worth more than all the iPhones you've skipped combined. 2014. The iPhone 6 and 6 Plus. Apple finally goes big screen, and the world goes crazy for it. They sell 10 million phones in the first weekend. The iPhone 6 Plus starts at $749. You see this not as a product you're missing out on, but as an explosion in revenue for your company. You invest that $749. 2017. The iPhone X. 10 years after the original, Apple releases the iPhone X, pronounced 10. It's the first phone to smash the 4-figure barrier, starting at a jaw-dropping $990. Pundits wonder if people will really pay that much. They do, in droves. That $999 price tag is a line in the sand. For a consumer, it's a huge expense. For an investor, it's a massive boost to the company's bottom line. You invest your $999. 2020. The iPhone 12. The 5G era begins. A new design. The base model starts at $799. By now, your portfolio is looking seriously impressive. The compounding growth is no longer a slow snowball. It's an avalanche. Let's fast forward to today. If you had followed this strategy, your total out-of-pocket investment would be thousands of dollars. But the value of that portfolio, based on historical trends, it would be well over $100,000. One analysis from 2023 showed that buying every new iPhone would have cost over $12,000, but investing that same money into Apple stock would have yielded over $117,000. You could buy the entire current lineup of Apple products in cash and barely notice the dent in your portfolio. This isn't about shaming anyone. It's about illustrating the sheer, undeniable power of opportunity cost. Every dollar you spend on something that goes down in value is a dollar you can't put towards something that goes up. 3. The mindset shift. Consumer versus owner. This whole story really boils down to one thing: your mindset. It's about a fundamental shift in how you see your money and your place in the economy. The world is basically split into two groups: consumers and owners. Modern capitalism is a machine that's brilliantly designed to convince you to be a consumer. Every ad, every product launch, every limited time offer is a psychological nudge to get you to spend your money on things. And more specifically, things that wear out, become obsolete, and need replacing. It's the consumer treadmill. You earn money just to spend it on stuff that loses value, leaving you in the same financial spot year after year. The iPhone is the perfect symbol of this. It's beautiful, it's expensive, and it has a built-in expiration date. Not because it'll break, but because the next one will be marketed so brilliantly, you'll feel like you need it. Becoming an owner means stepping off that treadmill. It means changing your perspective. Instead of asking, "What can I buy with this money?" you start asking, "What can this money become?" When a consumer looks at a company like Apple, they see a shiny new phone. An owner sees a global profit-generating machine with a legendary brand, massive R&D budgets, and incredible customer loyalty. The consumer wants to give their money to that machine for a product. The owner wants to put their money into that machine to get a share of the profits it generates worldwide. That's the mindset shift. It's realizing that real wealth isn't built by what you earn, it's built by what you own. You don't get rich from your salary, you get rich from your assets. Your salary is just the tool you use to buy assets. And assets are things that grow in value or pay you to own them. Stocks, real estate, a business. Liabilities and depreciating goods are things that cost you money. Car payments, credit card debt, and yes, that brand new phone. The point isn't to live like a monk and never buy anything nice. The joy and utility you get from an iPhone are real. But it's about being intentional. It's about prioritizing ownership first. Pay yourself first, as the old saying goes. Before you budget for the new gadget, budget for your investments. When you get a bonus, your first thought shouldn't be, "What can I upgrade?" It should be, "How much of this can I put to work for my future self?" This isn't about regret. You can't go back to 2007. It's about using that feeling of missing out as motivation to change your financial habits for the next decade. 4. The pattern is everywhere. And this principle isn't just about Apple. Once you adopt this owner mindset, you start seeing this pattern everywhere. Think about your morning coffee. Millions of people line up at Starbucks and spend $5 or $7 on a latte every day. That's around $1,800 a year. What if, instead of that daily latte, you had started investing that money into Starbucks stock, SBX? That daily habit of consumption could have become a daily habit of ownership, slowly building you a stake in a global coffee empire. Or think about Amazon. How many packages show up at your door? Every time you click Buy Now, you're a consumer. What if you made a rule? For every $100 you spend on Amazon, you invest $10 in Amazon stock, AMZN. Since 2007, Amazon stock has had one of the most incredible runs in market history. People who simply invested in the company they were already using constantly have been rewarded on a scale that's almost hard to believe. This applies to the car you drive, the clothes you wear, the movies you stream. Tesla, Nike, Netflix. These are all companies that sell us amazing products. They are also all publicly traded companies that let you own a piece of their future. The pattern is always the same. A massive group of consumers spends money on products that depreciate, and that money flows to a much smaller group of owners whose assets appreciate. Your goal is to move from the first group to the second. You don't have to stop being a consumer, but you must start being an owner. It's the most powerful financial move available to the average person, turning your consumption into ownership. If this mindset shift is clicking for you, if you're feeling that little spark that says, "I want to be an owner," then this is the moment to act. This isn't about finding a time machine. It's about making a better decision for the next 5, 10, and 15 years. If you want to learn more about how to think like an investor and practical ways to start building your own portfolio, hit that subscribe button. We post videos every week designed to give you the tools and the mindset to take control of your financial future. And I want to hear from you. It's a powerful exercise. Let me know in the comments. What's one purchase you've made that you now wish you had invested in instead? I read every single one, and your story might just be the spark someone else needs. So, a $599 iPhone from 2007 is now a worthless piece of e-waste. But a $599 investment in Apple would be worth around $27,000 today. And if you had consistently invested instead of upgrading, you could be sitting on a portfolio worth over $100,000. But even those staggering numbers aren't the real point. The point is the principle. You will almost always build more wealth by investing your money in appreciating assets than by spending it on depreciating goods. It's the simple, unbreakable law of building wealth. The pull of the new and shiny is powerful. Companies spend billions to make you feel that desire. But the feeling of financial security, of freedom, of watching your wealth grow while you sleep, that is a feeling no new gadget can ever truly replicate. Don't spend the next decade just buying products from the companies you love. Spend the next decade buying the companies themselves. The best time to start was years ago. The second best time is right now.